Welcome to the InterMarket Analysis video update. This is a weekly video where we look not only outside of the S&P 500 at other stock indexes as well as sectors, we also look at other markets because no market exists in a vacuum. And so these have a tendency to interact with each other, and sometimes we can get some clues as to what will ultimately happen in the S&P 500, which can then feed down into individual stocks and how they either move up or down. This is being prepared for Monday, November 5th. The first area that we look at is called S&P 500 valuation. Now, we can value the Dow, the NASDAQ 100, but there are a tremendous number of studies that just focus on the S&P 500 since it is considered the benchmark of the U.S. economy. We have a number of ways we can look at this. We can look back by looking at what earnings reports were in the past, and we can look forward to see what earnings are looking like going into the future, and then that can help us right now to make a little bit better decisions. First area we look at is called the TTM, or trailing 12 months, and right now we are considered to be expensive. The black line, which is the S&P, is above the PE ratio of 20. When we're at 20 or above, the market is considered to be expensive. When it's between 11 and 19, it's fairly valued. When it's under 10, then the market is considered to be inexpensive or cheap. And you can see that we can spend a number of years being expensive. So we don't necessarily use this as a timing mechanism. We can use this as more of a what is the condition of the market. On the bottom is a line that measures the distance between the S&P 500 and the PE ratio of 20, and we're well above that. So we're well above the zero line here, also suggesting that we are expensive. We can also look at this in the context of different historical events that have happened. The 87 crash, the dot-com boom and bust, the housing crisis, and then where we're at right now, just to get an idea of how these things change. There's another way we can look at this. This was developed by Robert Shiller, and it's also called CAPE, C-A-P-E. This takes an average over a period of time and helps us to determine, is the market at a fair value or is it considered expensive? Well, currently this reading is coming in at 29.5. To give us some context, we can look back in history and see when other things have happened versus where we're at right now. We can also look at the median and the mean price, which is like the average price, and we're between about 16 and 17. So coming in with the reading of 29.5, on a historical basis, we are considered to be expensive. So we're seeing some confirmation there. But the market doesn't do that. They look forward based on analyst projections and what they think in the forecast that they come out with. And this is what the stock market uses to justify either higher or lower prices. The S&P right now is coming in. We still use that 10, 15, 20 scale. So the S&P is at 18. So it's above 15, but still below 20. We keep an eye on the mid caps, which is below the 15 level, coming in at 13. And then the small caps are coming in at 12.1. We can put all of these on the same chart to give some perspective here. They put them in different colors, and they really have a strong tendency to move in the same general direction. Then when we're looking at the small caps, there are two main indexes that we look at. The Russell 2000, which has been very popular. That's the area in red here, and that's different than the blue line, which is the S&P 600, which is the small cap index. The blue line sticks better to the 10, 15, 20 scale, where the red line does not. And so I end up using them both. I cover charts of these pretty much in every daily video. Another area is growth versus value. When you want to buy low and sell high, you're buying growth stocks. When the market runs into more difficulties, you might switch over into value stocks. These are companies that maybe have been around longer, maybe they pay dividends, maybe they've weathered other economic storms, and so they may go down, but they may go down less than some of the growth stocks when we're really heading lower. We look at a peer growth index, and we are seeing a change here where growth was in an uptrend going back to last summer. Now we've been under some pressure, and we're starting to get a death cross here, even though we have been bouncing back over the last week. Value is also in a downtrend, but it's in a more of a stronger downtrend right now, even though it's been bouncing back a little. Where we get some insight is when we compare the two. We do a ratio between growth and value, and that's on the top. showing how growth is outperforming value even though it's been pulling back, and value has been underperforming growth even though it's been bouncing back up. And I have a number of different measures here. I use indexes, ETFs. We look at inverse charts because we want to be able to see the same thing at the same time, since all these different areas are calculated in a slightly different way. We look at an ETF of growth to value and take a ratio showing that growth is still in an uptrend when compared to value. This shows where value is underperforming growth. We look at some indexes. This is also showing that growth has been outperforming value. And here's another one with the indexes showing that value has been underperforming growth. Then we look at another ratio here showing how growth has been outperforming. And these are a number of different ways, different time frames. Some of the charts that I show you are longer term, some are shorter term, just to give us different perspectives on this. In a good, healthy environment, we want growth to be doing well. We also look at another measurement here using a rainbow chart showing that growth has been pretty much going sideways when compared to value, even though it has been bouncing back lately. And value has been underperforming, and it's also been going sideways. Then we look at the small cap growth to value ratio, where it's really been declining. Small caps have been under a lot of pressure. They had a really good day on Friday, but we've seen really good days before, only to have the next day give at least a lot, if not all of it or more, back in the next trading session. We need to see a more sustained move for the small caps. Longer term, this is still in an uptrend, even though it is going sideways. Now, I use this as a bullet point in the daily video where I say small cap growth to value is still in an uptrend, even though it has been seeing some weakness. We also look at the mid caps, which were stronger earlier in the year. They're still in an uptrend when compared to growth. And I say on the daily video that mid cap growth is still positive. And then we look at the S&P 500 growth to value ratio. And this is kind of interesting. We had a really good week this past week. The market was really looking to go a lot lower. We got to an oversold condition. We got to the point where interest rates started to fall, and we just turned around and boom, we're right back up to this previous level that we were at. Now, in that type of an environment, you'd want to see growth really outperform value. But look at what's happening down here with the ratio. Growth is really coming down when compared to value. So this is a little bit of a concern. To turn more positive, we want to see the growth to value ratio turn and go back up. We also keep an eye on inflation. This is a monthly chart on the top of the CRB index, and it's chopping sideways, but it's still in an uptrend. And when we look at a ratio down below between inflation and deflation components of the CRB index, it's still showing that the inflation components are not really shooting a lot higher. They're actually underperforming. We look at the CRB index, which continues to be in an uptrend. And then we look at the Baltic Dry Index, which really had been shooting up, and now it's starting to come back down, but it's still in a longer-term uptrend. This tries to measure what does it cost to ship products from one place to another, specifically within the Baltics. We look at some other markets, aluminum, just to keep an eye on this. We don't trade these markets. We don't really follow them all that close. I just look at weekly versions of a daily chart. And we're showing here that aluminum continues to be in a downtrend. If this was going up, that might be more inflationary. Corn is also continuing to be in a downtrend, as is wheat. Fertilizer, which had been coming back up, is now starting to go back down. That's more cost that could get passed on in the form of inflation. Oil has been really shooting up. We got up to 95 and now we're dropping back, but we're still in an overall uptrend. And when you look at gas, we're actually in a downtrend now. That's a little more friendly to the consumer. We look at diesel prices, which had been coming back up, and now they're starting to fall back slightly. That's what 18-wheelers and railroads use to transport goods. And the more it costs them, the more it may end up costing you. Heating oil is also in an uptrend, even though it's been falling back recently. But after really declining, as we've dealt with some geopolitical events, this has been starting to go back up. Natural gas also is still in a longer-term downtrend, but it could be getting ready to cross over into an uptrend here. And then copper, which is a barometer of the economy, it continues to be in a downtrend. So that is suggesting that the market thinks, looking out into the future, that the economy is not as strong as what they thought it would be. Now, this could be wrong and this could change at any time, but this has been going on long enough for us to see a trend here. We also look at a ratio between copper and gold. When copper is outperforming, that means generally the economy is looking better. When gold is outperforming, That means that the economy is weaker. Well, since we've been experiencing these geopolitical events in Israel, gold has been really starting to come back up, even though in the longer term, it's underperforming copper. Here's a longer term chart. The black line is the copper to gold ratio going back to 1980, where it has been declining. Just to get some more perspective, I put a 2-year and a 10-year yield on here, where we're still quite a ways apart from each other, but it's been that way for a couple years, where in a more normal environment, if even that exists, they tend to go in the same direction. And even though they're on different scales, they tend to not get very far apart from each other. But there's a really wide spread here, and they're having a tendency to go in opposite directions. We look at gold, which was really under a lot of pressure. It's still in a downtrend, but when the geopolitical events in Israel started to kick in, this is known as a flight to safety, and gold has a tendency to really shoot up, even though it has not surpassed the previous highs set earlier this year. We also look at silver, which had been in a downtrend and is seeing a bit of a bounce back, even though it's still pretty much chopping sideways lately. Then we have the closing value for gold on the top, the closing value for silver in the middle, and then we look at the correlation between the two, where they typically have a real strong correlated relationship. Well, as things have been going crazy over the last few weeks, we saw this correlation really get out of line, and now it's starting to come back and be a little more in hand with each other. So if gold is going up, silver could be going up. That means the correlation is strong. We also have a gold to silver ratio on the top. And when this is going up, that means gold is outperforming silver. Again, they both can be in an uptrend or even a downtrend for that matter. But what we've noticed here is we can compare this to the dollar index. When this is going up, that means that gold is outperforming silver. When this is going down, typically that means that silver is outperforming gold. And we can look at the correlation down on the bottom, which is getting a little bit weaker right now. So we can't trust this chart as much as we have been in the past. The dollar was down on the week and it really shot down, but it's still in a longer term uptrend. So when we look at it compared to the euro's been bouncing back up, but it's still in a longer term downtrend. We also compared to the Japanese yen, which has been going down compared to the dollar. And then I have some individual charts. Here's the euro to the dollar, which is in a downtrend. This might be a decent time to go to Europe. At least you'll get a good exchange rate for that. And then you might want to go to Japan too. The Japanese yen is really underperforming the dollar. And then you may end up finishing your trip in Britain, where we are seeing the British pound underperforming the dollar. Some different indexes. I show this in every daily video. The red line is the equal weight index for the S&P. That's where all stocks are treated the same. The bar chart that you see here is the regular S&P 500, which is a weighted index. So the bigger companies, the mega companies, they have more of an influence on the index. And when the red line is underneath the bar chart here, that means that the rest of the market is underperforming the big stocks. We have seen a nice little bounce back up here as stock prices have been going back up, but it's still underperforming. We look at a ratio between the S&P 500 and the CRB index, where stocks are underperforming the CRB, even though they've been bouncing back over the last week. We look at an inverse of that same chart where the CRB has been outperforming, even though it's been pulling back. We look at the NASDAQ 100, which is outperforming the S&P 500, which both had a really good week this past week. We look at the S&P 100 and compare it to the rest of the S&P 500. That shows that the bigger stocks are outperforming. And we look at the NASDAQ and the S&P 500, and this has been pretty much chopping sideways, but we're still seeing that the NASDAQ is outperforming the S&P 500. The NASDAQ 100 is outperforming the NASDAQ. And then the mega caps, the really big monster companies against the equal weight index, it shows that the big companies are really outperforming. We look at a ratio between the S&P and small caps. This continues to go down, which is more negative for the market. Now, small caps were up on Friday. Can this continue and start to go back up? We're going to have to see if something like that can play out. That would be more positive for the S&P. We look at a different version of the ratio showing how the small caps are really underperforming the S&P, even though they bounced back up in Friday's session. The biggest software companies in the U.S. are starting to show more of a downtrend, even though they bounced back up. They came right back up to their 50-day moving average. Can that continue? The mega caps are where a lot of the strength has come in 2023. Even though they've been falling back, they've been bouncing up, and we're still in a longer-term uptrend. We look at the robotics and AI ETF, which has been under a lot of pressure, and it's seeing a bit of a bounce here. But when we compare it to the tech sector, it's been really underperforming, even though it bounced up in Friday's session. The Dow Jones Composite Average, which takes the Dow, the transports, and utilities and puts them together, it just gave us a recent death cross here, even though it's been bouncing back up. It's been chopping sideways for most of 2022 and into 2023. We want to see this turn more positive if we're going to turn more positive on stocks. And then we look at the S&P 500 and compare it with shorter term bonds based from 1 to 3 years. And they've been really underperforming, but now starting to come back. We look at the broad market and compare it to further out bonds, where they have also been weak and now starting to bounce back. Low volatility stocks, which held up quite well in 2022, they're under pressure in 2023. Then we look at a ratio between low volatility stocks and the S&P, where we came down and it looked like we might be testing this bottom here and then bouncing back up. Well, as the market has been bouncing up over the past week, this ratio has been going down. We look at the tech sector and compare it with 3 to 7 year bonds, where it's holding up okay, and it's starting to show some improvement after we had been falling inside of the rainbow. Then we look at the S&P and compare it with other stocks. This is an advanced decline line studies. On the top is the common stock that's on the NYSE, where it has been going down, and this chart is actually incorrect. Forget this chart, it's out of date. All right, I'm going to go to the next one, Dow theory, which we're seeing a bounce back right now in the Dow. The transports have been showing some improvement, and utilities, which have been under pressure, are also seeing some improvement. But when we look at the transports to the S&P, we're not seeing an awful lot of strength yet. In a good, solid environment, we want to see this ratio going up. It's continuing to go down, even though it bounced a little bit on Friday. We look at the ratio between the Dow and the transports. When this is going up, that means the Dow is outperforming, and that's what's been happening lately. And we are starting to come back down since transports had a good day on Friday, but we want to see this continue in that direction to turn more positive. We look at the relationship between the S&P and the transports, and they still have a pretty strong correlated relationship with each other. This is a new take on Dow theory, where instead of using the Dow, we use the S&P, and instead of using the transportation index, we use the NASDAQ. We look for divergences and convergences here, and nothing is really happening all that crazy yet. Then the FANG index, this is Facebook, Amazon, Apple, Netflix, Google, and some other ones. A positive thing was the FANG index was able to get back above its 50-day moving average, and it's still in a longer-term uptrend. We also were able to maintain support. Now, intraday, we dropped below this, and we even dropped below this intraday just in the month of October, but we were able to come up and close up off of that. So for right now, it looks like this support level has held. ARK continues to be in a downtrend, even though it had a really good week. It was up over 15% just on the week, but it's got a lot of damage that needs to be repaired. And then we look at the S&P 500 and compare it on a monthly chart with stocks in Europe, Australia, Asia, and the Far East, where the S&P is outperforming stocks around the globe. And on a momentum basis, we're flattening out a little bit here, but we're above the zero line, again, just showing that the S&P is outperforming. We look at bonds. Here's the total bond ETF, which is in a downtrend. This is bonds based on price. World bonds are also in a downtrend and coming down to this previous low again. Are they going to be able to bounce up off of that? We look at a monthly chart of the stock to bond ratio, showing how stocks are outperforming. Then a shorter look here, showing how bonds are underperforming stocks. Then we look at high yield corporate bonds, which another name for this is junk bonds. They've been under pressure as stocks have been under pressure. This tends to follow the stock market, but they've just come roaring back lately as the stock market has been bouncing. But when we look at investment grade bonds, we continue to be in a downtrend. These are more conservative bonds. They aren't as attractive to folks because they give a lower yield, and folks are willing to take on more risk to get a higher yield. Here's a ratio that shows just that. The risky bonds are outperforming the more conservative bonds, and we're still well above the rainbow. And this ratio is actually held up even while the market's been under pressure. We look at a stocks to bond correlation where they're having a very strong tendency to go in the same direction. So if stocks are up, bonds are up, stocks are down, bonds are down. And then we look at the Dow Jones Corporate Bond Index, which this is now in more of a downtrend. And these are more conservative bonds that don't give as high of a yield. We look at the 10-year yield, which just a week or so ago, we were flirting with 5%, and now this has really been coming back down. Here's a longer-term look at the 10-year yield where we're trying to think, is there a paradigm shift going on here, a new environment, actually an old environment that's being revived? Because for 40 years, we saw a series of lower highs and lower lows as interest rates were going down. Well, now we're starting to break out above this longer-term trend line here. And maybe we're getting into an environment where we will have more or higher interest rates. The 30-year yield, which also went up over 5%, is now dropping back down. We look at the S&P 500 and compare it with the rise in interest rates. Stocks really bounced this past week, so that's why we're seeing this going up. But over the last, well, since about August, stocks have been in a downtrend when compared to the rise in interest rates. Junk bonds also seeing some weakness, but now starting to bounce back. And junk bonds are really outperforming more conservative bonds, which is probably the way it should be. Folks are really willing to take on more risk to get a higher return. Here's the 70-year ETF. This is based on price, where we are showing a little bit of an improvement with the MACD. We're seeing price starting to come back up, but we are working off of a recent death cross. The RSI is crossing back above 50. So on a price basis, this is turning more positive. And then we look at all the different maturities. We can see how interest rates have been going up. And then just over the last week or so, we've been seeing them really decline. And that's why stocks were able to rebound in the previous week. This is a weekly chart looking internationally, with the US having the highest rates, followed by the UK, that's black, and then Germany is in blue. We are seeing Japanese rates start to go up, but that's a whole different story that I'll get into. I'm watching that closely, and we'll see if that develops into anything. But it's been going on for quite some time now. We look at the MOVE index, which measures the volatility of bonds. That's been dropping. We look at the VIX, which is going down as stocks have been going up, and they have a pretty strong correlation between the two. We look at a monthly chart of the price of the 30-year bond, where it continues to be in a downtrend. And when we compare that to the CRB index, it's still outperforming, but this takes a long time to shift since this is a monthly chart. The blue line is still above the red line, but it is starting to roll over. Then we look at different sectors. The material sectors continue to underperform the S&P. Communication has been one of the stronger areas. It's outperforming the S&P. Energy, which was seeing a little resurgence here and actually had a golden cross when you look at this ratio, has pulled back in the last week. The financials, which shot lower back in March, have pretty much been going sideways and continue to be negative. The industrials are also underperforming the S&P. Tech sector, another strong area in 2023. It's continuing to outperform. Staples have been underperforming. And real estate, it was really up strong for the week, but it's still in a much longer term downtrend and is really underperforming the S&P 500. Utilities also bounced back up this past week, but they've been under a lot of pressure as interest rates were going up. We look at a ratio between the S&P and utilities. When this is going up, that supports stocks going higher. Now this is starting to come down, and so that's where we're getting some pressure on the market. Now, it did tick up a little bit, but we want to see this turn and start to go higher. Healthcare is in a downtrend compared to the S&P. Here's another look at healthcare, how it's underperforming. Discretionary, which has been a stronger area in 2023, but it's been quite weak over the last few months, maybe starting to make a comeback here. It's still in a longer-term uptrend, even though it's been chopping sideways. The staples are really under a lot of pressure. And it's not that discretionary is doing so good. It's that the staple sector has been doing really bad. They did bounce back up here later in the week, but they continue to be in a downtrend when we look at just staples. We look at the tech sector, which came under some pressure, has now been able to cross back above its 50-day moving average. The semiconductors also showing some strength and still in a longer-term uptrend. The tech sector to the S&P shows that the tech sector is outperforming. Energy, which had been bouncing back up here, well, in the latest week, when you compare it to tech, really has gone back to underperforming. And the growth areas, the buy low, sell high stocks compared to bonds, shows that the growth stocks are continuing to outperform bonds. The tech sector, the rise in interest rates, been chopping sideways. We saw a recent death cross here, but it's starting to make a comeback. And here's an inverse of that same chart showing how the rise in interest rates were outweighing any kind of rise in tech, even though it's falling back now. Discretionary to staples ratio shows that discretionary is still doing better, even though it's been under some weakness. We're wanting to see, can this get above its 50-day moving average? And then here's an inverse showing how staples are back to underperforming discretionary. We look at gold. It really spiked up in the face of these geopolitical events, but now it's been pulling back as stocks have been going up. So we're seeing this ratio coming down. The dollar is still hanging in there and it's still quite strong. So gold is, even though gold's been doing better, it has not been outperforming the dollar. High leverage loans, which every week I say this, if the economy was getting ready to fall off a cliff, would this be going up the way it is? Probably not. This continues to be in a very solid uptrend. We look at the NYSE composite, which is showing a recent death cross here, as we've been seeing some weakness in stocks. All stocks, also some weakness, but bouncing back, but still the uptrend is intact. Emerging markets, though, are in a downtrend. They've been chopping sideways for much of 2023. The microcaps are also in a downtrend. They set another 52-week low, but then have been bouncing back up off of that. We keep an eye on the home builders, not really seeing anything all that much in this chart. We look at the bottom area to look for divergences or convergences, and really they're having a tendency to go in the same direction. Bitcoin, which is enjoying some positive seasonality, it got up into the 36 range and currently is in the 35 range. And then we look internationally where China is trying to turn back up. It's still in a downtrend, seeing a little bit of an improvement in emerging markets. We're actually turning up in Europe. And Japan is trying to turn up a little bit, but pretty much flat. And we're seeing some improvement in the US, but not enough to turn this above its moving average. Then we look at intermarket analysis. Going back to the beginning of 2023, stocks are now back in the lead, followed by gold and then oil, and then the dollar, and bonds based on price continue to be negative. We look at some correlations where the dollar and stocks, specifically the S&P 500, are having a pretty strong tendency to go in opposite directions. That's why we watch the dollar index during the day. If it's down, that will help stock prices. If it's up, that might provide headwinds for stocks. We look at the correlation between the S&P and oil. This can go in the same direction in a healthy environment, but the rise in oil that we had seen, even though it's been pulling back now, that was more of an inflationary thing and a geopolitical thing that was happening, but they're still having a pretty strong tendency to go in opposite directions. We look at the S&P to the 10-year yield. They're also going in opposite directions. The tech sector to the 10-year yield, also opposite directions. The S&P to the 2-year yield, also going in opposite directions. Just a week ago, they were going in the same direction, and now we're starting to see a shift here as the 2-year yield has been going down as stocks have been going up. And then we look at some longer-term secular, which can be decades, and cyclical, which usually means years, trend studies. This is a monthly chart of the NYSE. It is bouncing back up here, but it's not quite back above its moving average yet. And on a momentum basis, using the Copic curve, it is showing a bit of an improvement here. Then we look at a daily chart with a thing called the NYSE record high percent index. This has been going down, even though you can barely see it. It's ticking back up slightly. And then we look at the S&P on a monthly chart with a PPO, the percentage price oscillator. It's been under pressure lately, but could be showing some signs of improvement. And then we look at a ratio between the S&P 500 and the CRB index, showing that the S&P is continuing to outperform. And then we look at the S&P and compare it to a global index on a monthly chart. And this just shows that the S&P is outperforming stocks in other areas of the world. The KST, which has been negative for all of 2023, could be getting ready to cross over positive. Then at the very end of this video, I look at the positive things and make a list. And my definition of positive is when the 50-day simple moving average is above the 200-day simple moving average. We have the CRB index, which is positive, the dollar, mega caps, the FANG index, bonds, when you only look at high yield or junk bonds, the tech sector and the semiconductors, the high leverage loans, the Dow. It's very close to giving us a death cross. It dropped below its 200-day moving average. It was able to recapture that on Friday. If we see some more strength, then we might be able to avoid that death cross. If we drop with the Dow, we might end up generating a death cross here. The NASDAQ and NASDAQ 100, though, they're still in stronger uptrends. Then we look at all stocks and Bitcoin. That was actually changed from the negative side to the positive side since we've just seen a recent golden cross. On the negative side, our list is getting a little bit longer. This is when the 50-day simple moving average is below the 200-day simple moving average. The growth indexes and ETFs, this is a new addition to the list, but the value indexes are also in a downtrend. Even though they're both in downtrends, growth is holding up better than value. Gold and silver are still in downtrends, even though they've been bouncing back. Copper's in a downtrend. The Japanese yen, the euro, the British pound, all compared to the US dollar are in downtrends. The biggest software companies, we saw a recent death cross there. The Dow Jones Composite Average, the low volatility ETF, ARK, is back to looking more negative, even though it had a monster week this past week. The NYSE Composite, that's another new addition to the list. The staples sector, as well as the total bond ETF, world bonds are also in a downtrend. The mid caps, the small caps, and the micro caps. And emerging markets are also seeing some weakness. And then we have the investment grade bonds. These are the more conservative bonds as well as corporate bonds. So thank you. I really hope you found this helpful. Please feel free to check out the daily videos that I do as well as the weekly video. I hope you have a great weekend, and I will talk to you in the next video.